Welcome to Season 2, Episode 3 of The Chartered Show. Today I'm joined by 3 guests. My first guest is Tiffany, Havinga, and we're going to be talking about the retirement two-pot system. I'm then joined by Simphiwe Mofokeng from Chartered Employee Benefits, and we're going to be talking about the Wealth Fund from Discovery. I'm then joined by Kerryn, Franck, and we're going to be talking about all things winding up in the state. So sit back, enjoy the show. Today I'm joined by Tiffany Havinga, and we're going to be discussing the retirement two-pot system. Welcome, Tiff.
Thanks, Kim. Thanks for having me.
Nice to have you on the show again. Now, this is a topic that I'm hearing in the media. I'm hearing it talked around about this two-pot system. Who does it apply to?
Kim, it's quite important that you ask that, because I think for a lot of our clients, this is not something
It's
that's
confusing.
Yes.
Because we go, like, does this apply to me? Okay.
Exactly. So it's really applicable to pre-retirement monies. So a lot of our clients that are already sitting in retirement that have living annuities, this doesn't apply to a living annuity. And it's quite important that we make the distinction. A lot of our clients call their living annuities retirement annuities. Okay. Not the case. Okay, so this is for your pre-retirement funds. So we're talking retirement annuities, pension funds, provident funds, and preservation funds, which a lot of our clients do also have. But yes,
Okay.
very much pre-retirement funding that this is applicable to.
But maybe just for us to start with, what is it? I've heard the word, the two-pot system, but now what is it?
Okay, so what they've basically done is they've said that they're going to take your retirement funding monies and separate it into 2 pots. The one pot is called a savings pot, and the other pot is called your retirement pot. Your retirement pot will pretty much have the same rules that are applicable to our retirement funds today. That's still going to be unchanged, really. The savings pot, however, has been made available for early access to funds, pre-retirement. So if you need money before you retire, there's going to be a pot of that money available to you. And what they're effectively going to do, Kim, is they're going to take that premium that you contribute every month towards your retirement savings, and a portion's going to go into the retirement pot, and a portion's going to go into the savings pot.
Okay, so Tiff, you're going to help me. I'm going to relate this to myself. I have a retirement annuity that I pay into every month, and I have a work pension fund, which I'm paying into every month. I'm now not retired, and I haven't been doing it this way. Is this still applicable to me, or does this only go with what I pay going forward?
So they are drawing a line in the sand, hopefully, or they're saying right now, the 1st of March 2024. Okay,
so this is when it comes into,
yes.
This is when it's going to start.
Yes, effectively. And it's actually funny that they're calling it the two-pot system, because there's actually going to be 3.
Two-pot is going to be 3. Okay.
Yes, because for all of the people that actually already have retirement funds,
yes,
our pre-March 2024 benefit is going to be ring-fenced. So that's your first pot.
Okay. So anything I've paid into up to now, both on my retirement annuity and on my pension fund, is ring-fenced.
Yes, and the old rules apply to that.
Okay.
Then all of your contributions from the 1st of March 2024 are going to be, the new system's going to be applied there. Okay, so that's why I'm saying there's actually three pots. Your ring-fenced pot, they call that your vested pot. Those benefits, same as what you had before. Then you're going to have your retirement savings pot, retirement pot, and your savings pot.
So in real terms, the reason they're doing this, if I'm understanding correctly, is so that people can have earlier access to the money.
Yes, and a lot of people are saying, that's not a good idea. Your retirement funding should be for retirement. But the whole reason this came about, Kim, was if you think back to when we were in the worst of COVID, there were a lot of people that were struggling to put food on the table, for example. And it's really harsh when you're struggling to put food on the table and there's a pot of money, and the only way you can access it is by resigning, being retrenched. I mean, apparently some people were even getting divorced just so they could get earlier access to this pot of money. So it was driving bad behavior. And then also remembering that you can actually, if you did, for example, get retrenched or resign from your job in that time, you could access 100% of your money. You were taxed quite heavily, but at least you could access your money. And so a lot of people were taking out all of their retirement savings. So in doing it this way, you know, there's a third of the money that you can take from your savings, and you can actually withdraw anything more than 2,000 Rand. So they have put a cap on what you can withdraw from your savings pot, and you can only do it once in a 12-month period. So they don't want you to treat it like a bank.
So what did you say you could, there's a maximum. What is that maximum you can withdraw?
No, the minimum. The minimum you can withdraw, 2,000.
Okay.
Yeah.
And you get that once off. So you're not coming back and saying, oh, well, now I need more money, now I need more money. No.
Once in a 12-month period. Okay, so yeah, minimum of 2,000 Rand, once in a 12-month period. The maximum, you can actually draw 100% of that savings pot.
And I presume it's taxed at the full tax rate then?
Yeah, so the tax of it, it's taxed at your, the withdrawals that you take from your savings pot are taxed at your marginal tax rate, which is high. So it's not, they are still trying to incentivize you to keep the money in your savings pot, but they are going to tax you at your marginal tax rate. So whatever if you're 45% taxpayer, you're going to pay 45% on that.
So Tiffany, let me just fast forward you now. You come up to retirement. You've now carried on paying, but you've withdrawn some of your money out. You now come up to your retirement, and we're working out what you're going to put into a living annuity. You are now going to, obviously they're going to take that amount that you've taken and take that into consideration.
It would have been taxed at the time, the savings pot amount. And remember, the old rules are still applying to your retirement pot. Okay.
So you'll still get your first X amount of money with 0% tax because you've already paid tax. So that'll still be applicable.
So if there is more money that accumulates in your savings pot, that you can take as your lump sum in retirement. Remember, the old legislation allowed us to take, well, still does, a third of your retirement fund in cash. And effectively, if you think about the contribution that they're proposing for this retirement fund, effectively about a third of your premium is being directed at your savings pot and the other 2/3 at your retirement pot. So the idea is then that your retirement pot buys your living annuity or your
No.
and then the other third will be your lump sum that you can take. And at that point, your retirement tables kick in again. And think about it again, Kim. So if you've taken a pre-retirement lump sum, income tax tables. If it's a retirement lump sum, your retirement tables kick in, and they are more favorable.
So in your opinion, Tiff, would you think this is a good thing for people? I mean, what I'm hearing you saying in one breath is that it might encourage people to take money out. And then in the second breath, I'm hearing you say, well, maybe it'll actually encourage the right behavior, because when you need the money, instead of going and resigning, getting divorced, or doing something really drastic to get hold of this money, you've now got a way of getting the money.
Yeah. So Kim, if I think about it for people that have got other funds, so the clients of Charter generally do have, we separate our balance sheet into those assets allocated towards retirement, and those are broken down into liquid and non-liquid funds. If you've got a liquid pot of money, this shouldn't affect you too much. Okay, you should rather take from that first. However, so it's beneficial for people who are in dire financial straits, where it's really tough and you're not able to, there's no other way around this. It serves those people well. People that have got a healthy balance sheet, that have been building up a good balance between your liquid and your non-liquid monies, they are unlikely to use this as quickly as somebody else would.
And I think if I think about the young people that we get to see, this is going to maybe encourage more of them to go into these funds, because I think for a lot of people, when you talk to them and you tell them you're going to go into funds, they say, no, I'm not going, I don't want to do the retirement fund because I can't access the money, number one. And then also what that's doing in real terms is it's stopping a whole lot of people actually saving for their retirement. So maybe this will encourage more people to go into retirement funds.
Could do, Kim. And even at the point, if you think about it, even at the point where you're needing a little bit of cash, you don't actually have to access 100% of your savings pot pre-retirement. You can access a small portion of it. So you might find people also not taking their full retirement fund benefit, but only a small portion of it to tide them over in difficult times. So there is good in it. But again, the best thing to still do is to chat to your financial planner around it to make sure that it's the best place to be taking your money from.
Well, I suppose that was going to be my next question. I now want to access some of the savings fund. Who do I contact? Do I contact the person my financial planner, or do I contact who we got the fund through?
So you'll contact your financial planner first,
Okay.
because you need to get the right advice around it. And they will effectively help you manage it with, if it's a retirement annuity, for example, they're going to be the people that help you with that.
So then maybe my final question is, we don't need to do anything. We just carry on contributing to our retirement annuity, to our pension fund, and it will just be legislation that will determine which money we can access.
Exactly. And I would also say, there's still a few unknowns around this. For example, how will a defined benefit fund be treated? So there are still a few things that need to be finalized and clarified. So I wouldn't change any strategy now. It's good to be aware, but there's no need for action right now, because I think there will still be a few changes before March 2024.
Tiff, thank you very much for joining us. I definitely understand it now, and I'm sure the listeners also understand it more. So just for those of you that are in living annuities and are already retired, it doesn't apply to you, so don't worry about it. It's more for people contributing up to their retirement, and it will be more for your children. Tiff, thank you for joining me. Thank you for the information, and I hope to see you on the show soon.
Thanks, Kim.
In this session, I'm joined by Simphiwe Mofokeng from Employee Benefits at Chartered Wealth Solutions. Welcome, Simphiwe.
Thank you so much, Kim, for having me.
Thank you for joining me for the first time on the show.
Yes,
It's always a big thing to be on the show for the first time.
True.
I mean, those nerves are there, but I can see you pretty calm today.
Thank you.
And thanks for agreeing to come and chat to us. And the reason I asked Simphiwe to come and chat to us is I've been noticing with Discovery Medical Aid, they've got some new terminology around. So I don't know if any of you have seen it. It's this wealth fund. Simphiwe, maybe just give us a little bit of an idea of what is the wealth fund.
Basically, what the wealth fund is Discovery decided to enhance their prevention and screening benefits through this new benefit called the wealth fund. It is a once-off benefit for all Discovery Health medical scheme members.
So when you say once off, is this once off forever or once off for this year?
Definitely, it's a once-off for a lifetime.
Oh my gosh, I went onto it last night because I knew we were doing a show, and I started getting excited, and I thought I'm getting this benefit every year. So I only get this benefit once in my
Lifetime.
I love getting the points on the vitality, and I get so excited about getting to my diamond status, and now I was thinking, I can do this every year. But okay, maybe let's take it back for the listeners now that I'm disappointed that I'm not getting this once every year and it's only a once off, but still it is. So what amount can members get for this once off benefit?
So firstly, it depends on your family composition. This can range from 2,500 to a maximum of 10,000 per family, and as I mentioned before, that's the once off in a lifetime that you will get access to these funds. And what I might add as well in there, Kim, is the fact that members will have access to these funds for up to a period of 24 months from the date when it was activated, and that basically means you as scheme members will have access to these funds. However, you will need to utilize these funds within that 12-month period.
Okay, so let's just go back a little bit. What do you think Discovery were thinking? Why have they done this?
So the thought process behind it, firstly, it came from the scheme reserves. So what happened there was the schemes are required to at least have 25% insolvency. So Discovery was sitting at 36% in terms of the solvency, and to give members the benefits or enhanced benefits. One way they thought of to introduce these benefits to members for 2023 was to enhance the screening benefits. So that's where it comes from. Not only that, when they were doing their claims assessments for the past 2 years, they found that medical scheme members were no longer going for their preventative screenings like your mammograms, your pap smear and such. So that's where it was coming from as well, to encourage members to initiate that process and start over in visiting their GPs or various healthcare providers to have these screenings done.
Because I know those are expensive when you have to go for your mammogram and all of those. It is expensive. So now what you can do is you book those. I'm just going to get this right. So I would book to go for my mammogram. Then when I've paid for it, I then can claim back through this.
So currently, Kim, you do have a preventative screening benefit that caters for your mammogram and pap smear screening. That benefit is not going away. However, through the Wealth Fund, Discovery is now enhancing that current benefit to ensure that you go for your consultations, and these consultations that come with these screening benefits are then funded by the medical scheme. I'll use a simplified example here.
I was just going to say, use me as an example because I want to understand this.
So if, for example, you need to go for your mammogram and pap smear screening, you need to see a healthcare provider, be it a GP, be it a gynecologist. So in that event, the gynecologist consultation as well as that GP consultation would usually fund from your own pocket or the normal day-to-day claims. But now Discovery is saying that consultation can be funded from the Wealth Fund. So your savings or your day-to-day benefits last longer now because there are these additional consultation screenings or checkups that can be funded by the medical scheme.
So Simphiwe, the way I understand it, and now I'm thinking, oh, Discovery's been really clever. They're not only helping us get more screening or encouraging us to get more screening, but in order to unlock this wealth fund, we also have to be able to done our health assessments. So they're doubling it because they're getting us to go and do our health assessments. Am I understanding that correctly?
Absolutely. So how that will work is members will need to go for their health check to unlock this wealth fund. So you can make a booking through any Clicks or Discam facility to go for those screenings. So those checks will then enable you to unlock.
So when you're talking about those checks, you're talking about the ones where we go and have our cholesterol done and our glucose done.
That's it. That's absolutely right.
So if I'm in a family like I am with myself and my husband and my daughter, we all three have to go and do those screenings, those health checks.
Yes, all the family members that are part of one membership will need to go for the screenings to make sure that you unlock your wealth fund.
So it's not just the principal member, it's actually everybody on that medical aid fund.
That's correct.
Okay, so that is something that's really good. But at the same time, I've heard a little birdie whispering, or maybe not a little birdie, I've heard it out there, that our Discovery Medical Aid has a price increase coming in April. Is this correct?
That is absolutely correct. What has happened is previously as scheme members, you were used to getting your premium increases at the beginning of the year. So come 1st of January, you would know that there's an increase coming up. In the last 2 years though, what Discovery has been doing is deferring premium increases. So the premium increase for 2023 will be on the 1st of April.
And what is our premium increase on the 1st of April?
I think that's a big question that everybody wants to know.
Here. Drum roll.
So various plan options will experience a different increase.
Okay.
Plans such as your Key Care, Saver, Core and Smart will experience an increase of 7.9%. And plan options such as the Comprehensive Series and the Executive Plan, those plan options will experience an increase of 9.9%. 9.9.
You know, when we do the planning for our clients, and we always work on inflation, but always with the medical aid, we say we cannot work on the rate of inflation, and we take medical costs and we up it to 9 or 10%, and here it is 9 or 10% as your increase on your medical aid contributions. But some people with that, I mean, there will be many people that when they see that 9% increase, they're going to go, like I can't afford my payments. I'm really, the premiums every month for my medical aid are too high. What are your options if you get to this stage now?
This is when I'd encourage medical scheme members to reach out to their financial specialists and conduct a plan review. So request for that plan review where they'll sit down with you, reassess your medical needs, reassess your financial status, and then that will enable you to determine whether a plan downgrade is suitable at that point in time.
So just for Chartered Wealth Solutions clients, speak to your financial planning specialist, and then they will call in Simphiwe and Paramesh and the team at Employee Benefits, and the team will actually reassess and have a look which plan you should be on. And it's only once a year where we can do that, or can we do that at any time of the year?
I always encourage members to do it anytime during the year when they experience a life-changing event. So here I'm talking about marriage, if there's a newborn child, if there is a dependent coming off the medical aid as well. Any life-changing moment would be the best time to have your plan review, but at least have it once a year.
That's very good advice. And just finally, so are we allowed to downgrade our medical aid any time of the year and put it up if we want to go to a different level?
Now with Discovery, you would be able to downgrade any time during the year. Moving to a higher plan though is limited to the year-end revision period, which is usually between October and December. During that period, you can then submit your plan change for the following year. Other medical schemes, because we are an independent financial advisor and we deal with various medical schemes out there, do have different scheme rules. Some medical schemes will not allow any changes whatsoever during the year and will only limit it to that year-end revision period, which is between October and December. So it will be totally dependent on your medical aid.
Simphiwe, thank you so much for coming in and sharing with us. I definitely understand it a lot more now. I'm still going to go back to the app and find it and do my health assessment so that I can unlock it, because you know what, every bit of money counts. Absolutely. And I've worked out, because 3 members of my medical aid, I can probably get the 10,000 Rand if I do it properly. I'll go and study up on it more. And thank you so much for just sharing with us and giving us the insights around the medical aid.
Thank you so much for having me, Kim.
In this segment of the Chartered Show, I'm joined by Kerryn Franck. Welcome, Kerryn.
Thank you, Kim. Nice to be with you.
So Kerryn is from Chartered Legacy and Trust, as I think most of you know, and I've asked Kerryn to join us today to just talk about all things when it comes to winding up estate. So Kerryn, it's quite a broad topic.
It is. It's a long process.
I know it's a long process, and you know, the reason I asked Kerryn to come and share with us today is we, at our financial planner meetings, we all get together. We get Chartered Tax, Chartered Legacy, and Chartered Wealth, and we all come together and we have these discussions. And so often what I'm hearing come from the Chartered Legacy and Trust team is, Kim, you don't understand what the delays are like when you're winding up an estate. And I thought it was just a perfect opportunity, Kerryn, for you to come and share with us, you know, what does it take to wind up an estate, and maybe help us understand a little bit more.
Process. So, Kim, it's quite an intensive administrative process. Some parts of it we have control over, but there are many other institutions that we deal with along the way where we don't have control over the process, and that's where I find a lot of the delays will come in. For example, when you report the estate, when someone has passed away, you've got to hand the reporting documents to the master's office, and once they go into the master's office, we then lose control over how long it'll take for the master to issue us with those letters of executorship.
And you say once you hand those in, it can take up to a month, 2 months to get your letter.
Absolutely, and I think most importantly, it's very unpredictable. So it's very hard for us to advise clients and say it's going to take 2 days for us to receive your letters of executorship, because it could take 2 months, it could take 6 months. It really does depend how the master's office is functioning at that particular time and what their backlog is like.
So Kerryn, that's with you being Chartered Legacy and Trust being the executor,
Yes.
then you give it in and you get the letter.
That's right. So even where we're not the outright executor in terms of the will, we still follow the same process. But again, even where we come on as the agent in an estate, there's nothing that we can start working on in the estate process until the executor has been appointed.
Okay, so Kerryn, you've now got the letter that says that you're the executor. Now what is the next thing you need to do?
Okay, so the next thing we do is we have to advertise the estate for creditors. They've got to, an advertisement needs to be published in a national newspaper and the government gazette. That has to lie open for a period of 4 weeks. That's something that we do for the clients, whether we are the executor or the agent. While that's happening, there are a couple of things we do behind the scenes. So, for example, there are a number of FICA documents we need to get for the clients. We need to open estate-led bank accounts. So those administrative things we deal in the background while that creditor's notice period is running.
Is it also at this time that you can help the clients to close some of their debit orders?
Absolutely. So we've got the letters of executorship, so we're in a perfect position now to be able to assist changing debit orders, changing across insurance policies into either the name of the estate or into the name of the surviving spouse. So a lot of those steps can be worked on while we're waiting for that creditor's notice to run.
So Kerryn, while all of this is happening, the financial planning specialist, do you bring them in to help you with decisions around what should happen with investments?
Yes. So we sit down with the financial planner. We'll discuss which investments we want to keep in the market, which investments might need to be liquidated. We'll discuss where we're going to find liquidity in the estate to pay for certain estate costs or liabilities. And we'll also discuss the timing of the liquidation of that investment, because there's no point, for example, if we need liquidity to pay estate duty only needs to be paid within a year of the person passing away. So we'll discuss with the planner when we do that liquidation in order to pay that expense, because it might be that we don't do it 6 months earlier than we need to. It's much more beneficial to keep the investment in the market.
And I think, this is a big reason why we opened up doing our own estates, because what we'd heard from clients is that, they were using other people, and this was happening way too early in the process.
Yes.
And actually the investments weren't invested through potentially what could be 18 months, 2 years, because people had actually cashed them in way too quickly.
Yeah, definitely, Kim. And we've also had instances where we've got an estate that's very liquid, and we've got a large sum of money sitting in an investment, and the planners will come to us and say, it's a really good time to get into the market. Could we maybe advance some of that inheritance so clients can take those funds, potential beneficiaries take those funds and get them back into the market, as opposed to sitting in an estate-led bank account. So that relationship with the planner, to work so closely with them, is hugely beneficial for the beneficiaries, because we're making investment decisions for them at the same time.
No, that's definitely, for me, a great benefit to the way we've done it.
Yeah.
Kerryn, so okay, we're closing, we're looking at investments, we're closing debit orders. Where else? What would be the next step?
The next step. So we now then start to collect the information that we need to put the liquidation and distribution account together. So we're looking at getting date of death values on various investments. We're looking at what liabilities we need to pay, where that liquidity is coming from. And once we have all that information, we draft in the liquidation and distribution account.
And that account, then, does that also need to go to the master's office?
That needs to go to the master. So that goes to the master for his approval. A little bit like the letters of executorship, it's very difficult to predict how long it will take the master to approve that account. If the file is readily available, we can sometimes get that approval in a couple of days. However, where the master is looking for that file, or perhaps it's a very old file, we're looking at perhaps 6 months, 8 months, even sometimes a year for that liquidation and distribution account to be approved.
And I know the frustrations that you've had obviously over the COVID period, and now with load shedding, when these offices just don't work.
They don't. Funnily enough, Joburg is one of the better ones, and that's the office we work with the most, which is quite fortuitous. Unfortunately, Cape Town, they are struggling with backlog to the extent that they've actually closed for the last 2 weeks to try and catch up.
Sure. So added frustrations in it.
Yes.
Kerryn, we get that back, all things going well. We've now got L&D back. What I've heard you speak about a lot is your work that you do with SARS and with the help of chartered tax to get people's back taxes paid and correctly done. Is that also for the Master's Office?
It is. So the tax has got to work concurrently with the winding up of the estate, especially where estates are dutiable. The tax liabilities that we put into the liquidation and distribution account can make a significant difference on the estate duty that's payable. So that's why the relationship with the tax practitioner is so important, because we need to tie up the timing of the tax returns with the date we're submitting the liquidation and distribution account to the master.
I must say, when I think back to when I did my will and that who I write as my executor, I'm really pleased that I took my husband off as the executor, because this seems like an incredible process that goes into actually winding up an estate.
Yeah, there are, Kim, there are a number of steps, and also there are ways, the longer that we wind up estates, we realize where the delays can occur, and we try and preempt those, and we try and, there's no point in administering the estate and then starting the tax. You are adding potentially years onto the administration process if you do that. The tax work needs to start really early on. Collecting the tax information is a difficult task, because you're not asking for tax certificates in necessarily a full tax year. You sometimes having, especially the year in which the person passed away, your tax certificates are running different dates. So the institutions, you asking them to manually do tax certificates, all of that takes time.
So Kerryn, what I'm also hearing, and we're coming to the end of our interview, and I think we could probably have more than an hour interview to get through this process in the way we should.
Yeah.
But really what I'm hearing is you should have your stuff organized. And I know we talk about having that legacy folder with all of your documents together. Does definitely help the whole process.
Definitely does.
Sounds like having your taxes paid up to date definitely helps the process. Is there anything else that you could maybe add that would help the process for the business?
Well, I think the tax, it's also the expense that you get. We've had clients that have had 10 years worth of tax returns out of date. That's a big expense to get up to date.
And that must now be paid by the estate.
That's got to be paid by the estate, and that's got to be done before you can do that to date of death tax return. Otherwise, SARS is not going to do that assessment. The other thing is, we do have clients that have got PTYs or close corporations. Those tax returns and financials also need to be up to date for the winding up of your estate. So I think to keep everything current, up to date, in a place where the information is readily accessible, is a huge benefit to us when it comes to the estate administration.
Thank you, Kerryn. Thanks so much for sharing just what sounds like the tip on the iceberg of this actual process. We're very grateful that you do this for us to help the clients, because at a time where we should be grieving and we should be dealing with our emotions, it's really nice to know that we have Chartered Legacy and Trust doing this work for us. So Kerryn, thank you very much.
It's a pleasure, Kim.
Thank you for joining us for this episode of The Chartered Show. Please feel free to like, share and comment, and remember, we also put these in our newsletter so you can read articles with more information that go with the show. Thank you.